This is my commodity wheel blueprint to make about 10 to 15% a year, obviously depending on the year. And this is basically somewhat of a guaranteed income, but you have to follow very specific steps and make sure you don't over leverage. My name is Eli. I'm a professional options trader. I manage over $9 million of family capital, and I'm not here to sell you any courses. I don't do any of this paid stuff. Please enjoy the video and be ready, because this is going to be a pretty heavy one in terms of the processes, but shouldn't be too bad. So let's begin with the blueprint. So step by step, this is exactly what I do, and this is what I found to work amazing for commodities specifically. So this will not probably work for stocks, but for commodities, this is kind of the most optimized way of going about it, and obviously staying pretty conservative and safe. So some people might be a bit more aggressive and can make a bit more money, but for me, it's, I'm not looking for the return, I'm looking for the capital preservation. So step number one will be to identify the low price for each commodity. So I'll give you a quick example. If, for example, we know natural gas historically is at the lowest level, at its lowest levels was around $1.5. So if the price is around $2, $2.50 for natural gas, it's considered a pretty low price. And I will show you the exact process also live with a few examples at the end of the video. So this is just gonna go over the theory. But it's very, very important to understand what is a low price for each commodity, and it's way simpler than you think. So step number two will be to sell puts at that low price level around 45 days to expiration and take profit at 50% of credit. Really important to stay at around 45 days, because this is where theta decay is really, really big. And we want to take advantage of it, of when the theta accelerates. Step number three will be to roll the position if it's down 50% or more, and you will roll it out in time and down even more, possibly for a net credit, maybe a very small net credit, or for just a $0 roll. So basically you buy back your option and you sell a new one for the exact same amount, which will give you a net result of going out of the money even more and adding time to your option. So step number four will be to roll, or if the price keeps falling aggressively after the first roll, you will roll out and down again. So you will do it the second time, the second and last time. You don't want to keep rolling forever, because this is not a very optimal way of doing it. Again, some people might do it. It will work if you keep rolling indefinitely. You will eventually make money. But again, all depends on your position size, and if you found, if you initially sold the put options at a low price level. If you didn't, then it might be really, really painful. So step number five will be, if the price keeps dropping aggressively after the second roll, I will just let the option expire in the money if it does, and then I will buy the future contract itself on the day of expiration. Now, futures, most of them are European style, which means you don't get automatically assigned a future. You will need to do it manually, because they are all the options and all the futures are cash settled. Something basically like SPX, but the futures are also cash settled. So and you can buy them as opposed to the SPX. So really important to note on that, and I'll talk about it a bit more in the next slide. Step number six will be to sell calls at around 45 days to expiration. If you ended up buying the future, same strike as the last rolled put strike, and just gonna let it go to expiration. If it's up, let's say 60-70% on credit really quickly, then it maybe makes sense to close that position and maybe just sell a new call with a different expiration. But generally you want to keep it, let it go to expiration, and hopefully the price increases and you get cash settled on your calls, and then you sell your future as well for a gain, which will end up just kind of giving you a net positive gain. Step number seven is, if price goes up, sell the future contract on the day of the call option expiration, and if price continues to go down, keep selling calls to collect more premium. Now, I've tested it for decades, as a back test, and also a forward test for quite a few months. and 99.9% of trades will end at step 3. And this is because commodities mainly crash upwards, which is really important to understand. Commodities mainly crash upwards, and no producer is benefiting from extremely cheap commodity prices. Also a big one to understand. Nobody wants cheap oil prices or super cheap gas prices for a prolonged time, because companies, producers, exporters, they don't make, basically, their margins go thin. So this is why a lot of times, if crude oil goes down in price, suddenly you see some kind of move and some kind of news breakdown, and price goes up, and it's just some kind of player in the game just moving the price upwards, because it doesn't make sense at this low level to do business anymore. So this is something to keep in mind, and this is why it's very different from stocks. In stocks, they can keep falling down, and keep going down, and they can go down considerably. Commodities, it's very different. Now next we have the management, position size, and the products to trade. And this is also one of the biggest things, the position size. If you don't get that right, you'll probably make a lot of money up until there's some kind of critical situation, and you just won't be able to either roll or buy the future, because you will just be over leveraged. So this is important, because futures are, it's very easy to over leverage with them. Futures options. So the products to trade and the position size for gold and silver, it will be one contract per every 400K in the account. So most people won't even be able to trade it, but this is how big the gold and the silver market is. You will only be able to sell one put contract per 400K in capital, right? So this is quite extreme. But the other products, we have copper. You can sell one contract per every 100K in the account, one put contract. Crude oil is 2 to 4 contracts. Some people will go on the low end, some people will go on the high end. And natural gas is 3 to 5 contracts per 100K. And this will make sure that you basically have enough room in your account to handle any kind of move if it comes to it, and obviously with even a bit more restrictions. So it's not like if natural gas goes down by 50%, your account will go down by 50%. Also, it depends on at what point you will be buying the contract, the future contract. But generally speaking, 3 to 5 put options / futures contracts are good for natural gas, 2 to 4 for crude oil, and 1 for copper per 100K, and then just 1 contract per 100K for gold and silver. Now I didn't include the wheat, corn, and soybean, because they have extremely cheap put premiums. So you cannot really do it, because the fees they will just eat up into your put profits. Doesn't make much sense, and I'll make a separate video on how you can wheel these products, which is a bit more interesting but also simplified. Now, position size must be small to handle price swings and rolls, as we just talked about, and this is really one of the keys to make it work. If you get this right, the position size, and you get your initial put price level right, then basically it's guaranteed income. It's just a matter of when you'll get it. So management. So the initial short put profit target is 50% of credit, like we mentioned. Any rolled short put profit target depends on the roll, on when the roll was done. So the profit target needs to be manually calculated to profit the original initial short put dollar amount. So if, for example, you sold your short put, your first one, for a credit of $1,000, right? So your take profit will be at $500. And let's say you rolled your put option for whatever amount. You need to set up your profit target on the new rolled put option. So you will be profiting a net of $500 on this entire position, right? So you will make back whatever was the unrealized loss for the initial put option, plus $500 of net profit, which is what you would have made on the initial put if it would have been at 50% profit target. So it's really not too complicated, but this is important to keep in mind. Now, short calls profit target are held to expiration unless they are at a large profit of over 70% very quickly, at which point they can be closed and new ones opened. at the same strike, but at different options expiration, so you can collect more credit. I think this is pretty self-explanatory. You know, if you have an opportunity to take a lot of profit very quickly from the table, then you probably should do it. And last thing is futures options are cash settled. Therefore, buying the future needs to be done manually, as well as selling it manually when the options expires. So like I said, futures options are, for the most part, are European style. So everything we discuss here is going to be European style. So you will have to manually buy the future if it ever gets to it. You will not be automatically assigned to it, if it makes sense, or called away. Let's continue to rules to follow, and then we'll go over exact examples of each and every step. And I promise you, it will all make sense. It will be much easier than you think. Now, step number one, or rule number one, is never be greedy and choose higher put strikes for better credit, or add more contracts. This is what a lot of people probably are gonna do, and this is a one way into blowing your account, basically. Over leverage and greediness. This is the things that rob every good options trader from a good career as an options trader, if it makes sense. The second thing is, if there are no good opportunities, there's no need to force a trade. There's nothing, then there's nothing. You don't have to trade it, right? It's just, this whole business is very opportunistic. So you need to trade if there's an opportunity, and if there's no opportunity, then you just, you don't use this technique, you use something else maybe, right? So this whole thing is not like a main strategy. This is just another approach that you can use as part of your trading. And depending on the market conditions, sometimes it's perfect for these conditions, sometimes it's not. It really depends on what the market is doing. Third thing is, this is a low risk, low return approach. Some years will be more profitable and some much less. So don't expect for this to become your main strategy, just like we discussed a second ago. Fourth and last thing is, the goal here is to prioritize taking profits from put selling. Buying the future itself and selling calls is the last line of defense and not the go-to approach, right? So I want to make sure that I'm as efficient as possible, and I don't want to be holding any futures if I don't need to, right? So it's kind of a like a wheel strategy, but where the wheel itself, or I guess where the second part of the wheel, where you buy the underlying and sell covered calls against it, is the last line of defense, right? Which is pretty typical for a lot of the wheeling that people do. So this is important to remember. So a rule of thumb is to usually when prices go down in commodities, volatility decreases, and when prices go up, volatility increases. So this is why this approach is way more beneficial with commodities as opposed to stocks or an index. Like I said, commodities, they crash upwards for the most part. Therefore, when price goes down and you have a short put, volatility doesn't increase. It usually goes down, which will benefit your option. So this is very different from selling puts on the SPX, for example. And when price drops down, volatility increases, and you are in a lot of trouble, right? In this case, this is quite the opposite. So if there are some critical news, prices will go up, volatility will go up as well, but prices will also go up, which ultimately benefiting our short puts. And this is exactly the position I want to be putting myself, where I don't care if there's some critical news. Actually, I prefer to have some critical news, because price will be moving away from my short put. So hopefully that makes sense why this is very unique and very beneficial, and pretty much guaranteed income and cash flow if done right. So let's look at a few examples of, and the most important thing will be where to find the right put strike to sell, to start this whole process. So let's take a look. So step number one will be to analyze and see where is the current low price of the commodity, or to be a safe distance. So let's begin with gold, which I know might not apply to most people, but we'll do an example of a few things. So let's go over here, and this is a demo account, just being transparent here, and because I want to be probably opening a few positions here to show you what's going on. So ideally, we're looking to whatever is closest to 45 days to expiration, and I want to be over 45 days. So closest will be 64 days. And as we can see, this is a March expiring option for the April expiring future contract. So we'll go to the trading view. We'll type in gold, and we'll go for April, which is already the contract we are in. So let's just see what will be a low price for gold to be able to wheel gold. So first thing that really just comes to right to mind will be to be underneath this this little low over here. So it will be probably anything about 4,000 and lower will be a good option. So I will probably want to wait for a pullback to enter a position in this case, because gold is at an all-time high currently, right? So you always want to be waiting for maybe some kind of pullback or some kind of favorable price action, and not entering on a crazy up move. But I will look at anything at 4,000 and under for gold currently. So let's see what kind of credit we can get. And it might not be very attractive. Then we just might not do it, right? So for one contract we can get about $770. So really not a lot, given that this is a $400,000 account, right? So it doesn't make sense. Some people, again, they can do it. They can do more contracts. I wouldn't do it. I wouldn't really look at gold currently for to do something like that. But this is kind of what I would look for specifically when I'm doing this stuff. So gold is not a prime example currently. It's an all-time high, but I was just gonna keep an eye on it, because if price drops, there's a possibility where this put will gain a lot of value, and we can actually get filled for a much better price. So I'll follow and look at that. Now for silver, it's kind of a similar situation. You can either go to the 50 strike, or maybe anything underneath the 56 strike, because the price is really stretched to the upside. So these things are usually really hard to wheel because they're in a very strong uptrend. It will be the same thing for copper. It will be really hard to wheel it easily. Ideally, you want maybe something of strike 5 and under, because again, this is where the previous support was. So let's look at copper and see maybe what we can get for copper, which is a one contract per 100K. So let's see, we have 64 days to expiration. This is the May expiration, and we are in March. So let's go to copper and open up the May expiration. So we're looking at let's see what we get for the $5 strike for copper. And we, as you saw, we have a pretty nice pullback. So here, in terms of credit, we can get, it's not too bad, it's $938, so about $1,000 in credit. I would consider it pretty nice. Might be actually a very good entry. And price is already pulled back. The news are very bullish. And if something happens and price keeps dropping down, we can always just roll it out in time and down, and most likely get it closer to this lower price over here, which is again part of what we want to do, right? Now, specifically right now, there's this whole situation with the, as I'm making this video, the situation with the tariffs, that the US might impose some tariffs on copper. So this is why specifically I wouldn't touch copper until the tariff announcement, because this is what happened last time. Price dropped quite a bit downwards. Firstly, it went upwards, and then it crashed all the way down because of the tariffs. But initially, it went up a lot it crashed up basically on the news that the tariffs will be applied to refined copper. And when they ended up not being, the price kind of dropped back down. So this is what I would look for copper, but again, not now because of the tariff news, because this is also something you want to be looking at. Next, let's look at natural gas. Natural gas was actually a trade I just tried to do, and I just did not get filled on my position. I chose the $2 strike. The price was right here, and the reason I chose the $2 strike is because if you go to the history, the $2 strike is lower than the previous multi-year lows. So I was pretty comfortable with selling that put option. and just rolling it down if I need to quite easily. And I ended up not getting filled. I sent the order for a bit over the current price. It got one tick away from getting filled, and it just didn't get filled, and the price reversed, and the position profited quite quickly and easily. And you could have made on this position easily 1 to 1.5% on your entire account within a few days, which is pretty good. But you have to wait for good opportunities and find situations where it's pretty safe to do it, if it makes sense, and keep the position size pretty small. So last but not least is crude oil, which is what I currently have a exact position like that on crude oil at strike 50. Prices went up, volatility was high, and it pulled back on this massive pullback day. So I entered right at the bottom here before the price went up and strike 50, and I collected a nice amount of credit. I can easily make almost a percent on my entire account here, and the position is already up. I also have the position open on a demo account here, I believe, but it's already up like 20 some percent, so it's pretty good. The reason I chose this strike, the $50 strike, is again, if you just look at the history and you can see the price, you can see the previous time the price has been underneath the $50 strike was during the low demand season after COVID, so 2020. Demand went down, so crude oil prices went down, and I still feel like it's pretty far out of the money. And again, the producers and exporters are barely making any money at $55 a barrel, right? So at $50 a barrel, there's no incentive for anyone, for any country, any producer, to have the price of oil that cheap. So this is also one thing that you need to consider. So let's recoup. It's all about the right position size, which is easy enough. I gave you all the contract sizes. I'm sure everyone that watches this video knows how to open a position, roll the position. They get all the technical stuff. This is not a big deal. I guess the quote unquote secret sauce here is just to finding the right strike, right? This is kind of the biggest thing, because if, for example, let's say the situation is a bit different. Let's say we are right now right here, right? So this is what we're looking at. It's the beginning of December, and you decided you want maybe to sell some puts on natural gas. Now, natural gas is a unique one because usually you wouldn't want to trade it during winter time. Really important. But let's say this is not winter time. What would you do here? Would you sell something just underneath here? All right, is this going to be a good enough short put option? Or first of all, you might let's say you wait for a pullback to enter, right? Okay, we got a pullback now. So would you still enter at this level? Would it be smart? Yes or no? So the answer is it would probably not be smart, because you can just go to the left and you can see, well, price has been lower just a little while ago, right? So in this case, I would consider, okay, let's make sure we're below the level at maybe 2.9, right? So 2.9, I would consider it a much safer bet. So and if I would look a bit back in the history, I can see, okay, prices has been way lower. Maybe for me to be a little bit safe, I can even go to 2.8, give or take. With this I will feel much more comfortable, right? So what ended up happening here is price just kind of kept climbing down like crazy. So what would you do here? You would probably roll this position out and down, and you can probably easily do it to the 2.4. Yeah, probably to the 2.4 mark, give or take. So what happened is price kind of went up. On this move, you could have probably recouped some of the profits. I'm not sure exactly what would have happened, but ultimately price ended up going down again. So in this case, you would have done the exact same thing, and this time you would roll to the $2 strike, or even below that, right? So it really depends. and this will be the last time you would roll. And at this point, you will just keep the position open. And obviously, the price kind of went up. So you know, if you would have had this position, you would have made money. And this is something you wouldn't do with natural gas, because you don't really trade it during the winter time unless the price is really, really low. And this is an opportunity, right? At $4, the price is, you know, it's actually closest to the highs, right? So you don't want to be caught in the situation where you have to roll the position twice. So this would have been somewhat of an extreme situation, which again, you would have ended up also profiting, right? Or if the price would have went all the way down, again, you would have just bought the future itself, start selling calls at $2, at the $2 strike, and you would have made money anyway. It just depends on how long you would have taken. And you know, I guess the more important thing is not only the strike selection, it's also the position size, because a small position, you can really roll indefinitely. You can keep rolling indefinitely. Yeah, you will have a big unrealized and / even realized loss every time you roll, but you can keep doing it indefinitely, basically. And eventually you will be right with commodities, because you know they will never go to zero, right? But you can keep rolling all the way down to to really low levels. So I guess like you heard many times before, it's all about position size, but at the same time, we want to be as efficient as possible, right? And sell, be in and out as quickly as possible. And some years it will be much easier, some years it will be much harder. So crude oil is a good example of something that would have been way easier to trade, basically since April, after, I guess, April 3rd, when the price dropped after the tariffs. It would have been really easy to trade it since April up until now. So every time we have a good price pullback, we can go to a very low put strike, sell it, make some money, and I guess there's basically no case here where you would have needed to really roll the position. Maybe just once over here, depending on what would have happened. But again, here we had some news with China and whatnot, so you would have avoided having anything in these positions, and maybe enter after this big pullback, which again, you would have made money quite quickly. And then here as well, and then here and there, you would have made money more and more and way more often. And especially because we are looking at 45 days, theta is pretty nice and large, you would have been out in the position quite quickly. So hopefully this video was useful. Now, I know this might have not been the most, I guess, eye-opening thing that you might have seen, but at the same time, I think a lot of people are not aware that you can, really safely will commodities as long as you keep position size small, and you just know what is a relatively cheap price for commodities, right? Then when you find something, you just execute on it, and you can profit for quite a long time and quite nicely. So thank you again for watching. If you have any questions, let me know. Again, hopefully you find some value in this video, and I will catch you in the next one.